All right, we're live. Good evening, everyone. It is Thursday, December, I want to say it's December 9th. And I am going to present tonight on why I think now is the right time to buy puts. So, first of all, it never really feels like the right time when it is the right time. But let's take a look at this. What is going on in the stock market? What is the reason that's given for buying the S&P right now? What's the number one reason? Like if you look at Goldman Sachs research, it's money flows. It's passive money flows. So that's money that goes into the market each and every day from, corporate buybacks and the like. Now, to me, that seems like the worst reason ever to buy the stock market. Okay. You got smart money selling, you got insiders selling at an unprecedented rate, right? Like Bezos, Musk, all these guys. They both sell $10 billion this year. And what's propping up the market is passive money that isn't necessarily even driven by logic, right? It's just sort of like an allocation. So if dumb money's buying the market and smart money's selling the market, I don't see that as a strong reason to buy. I mean, I get the money flow argument that it's a technical or a structural prop to higher prices, but you can't tell me that just because there's corporate buybacks or passive money flowing into the money market that therefore the price must go up, right? So the next question is, what is the market built on? Like, why are we at 4,700 when we were at 2,200 in March 2020? That was 21 months ago. Does anyone know the answer? Does anyone care? I mean, why is it? Why are we so much higher? I mean, technically, I guess I'd say this. A simplistic description would be to say that the stock market is a discounting mechanism that predicts what the future earnings of companies are going to be and then trades shares of those companies based, rationally based on those expectations and some other factors. What are competing returns for capital? What can you get out of a bond versus a dividend? All of those things. But a lot of it is based on expectations of the future, right? It's a discounting mechanism of the future. But we all know that's a simplistic description. And that sentiment and uncertainty play a large role in what that multiplier is that investors are willing to pay on current and future dividends. And it's that uncertainty component that I zero in on here. So we're in a situation where the Fed is reducing their rate of purchases. They're tapering, right? I know they're not raising rates, they're tapering. And you also have, Mr. Powell, the Fed chairman, coming out and saying, we're going to retire the word transient when we're referring to inflation. So we're no longer talking about transient inflation. Now, you could interpret that as hawkish. When he said that, the market did interpret it as hawkish. Other people say, no, that's just an academic distinction to kind of further refine what they're talking about when they say transient inflation. But these words, and even the fact that they're reducing their rate of purchases, that isn't that significant in itself, so much as these things significantly introduce uncertainty into the mind of the investor, and investors don't like what? They don't like uncertainty. Investors do not like uncertainty. So we have a market that's built on passive money flows while smart money is selling. We have a market that we know is entering a time of more uncertainty, okay? And it's not like this is happening months in the future. We're talking about a Fed meeting next week. We're talking about tomorrow. Okay, this I think was 7 on my list, but tomorrow is the last day of corporate buyback window for the year. So even if you buy into the flow of money argument, for the rest of the year, we won't have that tailwind in terms of flows. Now, if you've watched my channel, you know that I have this argument about the fact that the third quarter ended with a what's called a gravestone doji, meaning it rallied up and sold off to the level that it started the quarter at. So that if you want to use that, the logic of that would be that collectively we as investors decided that anything above whatever this is, 4,300, this 4,300 plus level was not justified. Now we're up to 4,700. But what if we close back at 4,300 at the end of the quarter, right? So now this isn't one of the things on my list, but this is something I've been talking about, that you see a sell tail doji on the third quarter. You see a sell tail doji on the month of November. We're back up in that tail now. So yeah, I mean, if we close up here at the end of the year, great. Green light. Let's go 2022. You know, I can see it. I can see a reality where that is true for sure. But right now, what I see is we're very close to this 4,700 pin. VIX got sold off like a beast through Wednesday, and today it rallied, but just got totally destroyed, right? Still elevated though. Still elevated, but you know, protection is cheap. A lot of the protection got sold, and now here we are facing down the barrel of a gun called the Fed, talking about being more aggressive in its tightening. Okay. What are we on? 4. Reason number 4. If stock prices. Oh no. Reason number 3. Indices concealed the downside volatility of many single meme stocks. So I'm trying to get through this quickly, but names like Tesla, AMC, there was significant put buying today, and that could destabilize the whole market. So that possibility exists. Number 4, if stock prices drive performance, what do the top stocks look like? So there was this interesting chart out on Twitter today. It actually was not. Oh shoot! Did I get rid of it? Well, I had it up here. Here it is. Okay. So actually, this is wrong. I did the math, and so did some people in the comments. It's not true. So without the 5 biggest stocks, the NASDAQ would be up 11% instead of, 17%. But the general point is accurate. And that is that the top 5 stocks are up, I think it's 43%. Where did I do the math? 45%, 45.3%. And the rest of the market is up 10.6%. So NASDAQ is up 25.8%. Without those top 5 stocks, which is what? Apple, Microsoft, Google. What are the other 2? Tesla, Amazon. Apple, Microsoft, Amazon, Google, Tesla. Without those 5, the market's only up 10.5%, 11%. So most of the performance is driven by those 5 stocks. So let's look at those 5 stocks. Let's just pull them up and have a look. Okay. Number 1, Apple. This stock looks terrible. This stock looks absolutely horrific. Okay, we've got this huge rally, and then we've got this gravestone doji up here, right? I mean, it's kind of like this, except we're even higher up in this rally. We're further away from the 50-day moving average, and you've got this gravestone doji. That looks terrible. And this is the number 1 stock in the NASDAQ. It's the number 1 stock in the S&P, and that's the chart. Microsoft. You have to do this for all of these. Microsoft doesn't look as bad, but you do still have a sell tail. You're closing in this buy tail from Wednesday's trading session. You have this super bearish, top bar back here, and you're in a right shoulder. So I'm gonna rate that as like very bearish. It's not ultra bearish. like Apple is, but it's very bearish. Next up, what's the next one? Amazon. So Microsoft, I guess I'd rate as moderately bullish. Amazon would be somewhat, okay, I said bullish, I meant bearish. Apple's max bearish. Microsoft is moderately bearish. Amazon is somewhat bearish. You got these three sell tails above 35.25, closed at the lows. Tesla is, in my eyes, the least bearish of the five. You have this buy support below 1,000. You've got the 50-day moving average of support. But the outlier here is that there's all of this put volume bought today in Amazon that could be destabilizing from a gamma perspective, okay, especially if market volatility jacks up. Google looks a lot like Microsoft. It's in a right shoulder. You've got a Greystone Doji sell tail. Not as bearish as Apple. Kind of the same as Tesla, as Microsoft. I'd rate that as moderately bullish. Moderately to, it's a little bit more impressive of a sell tail, so maybe I'd go moderately to extreme bearish, but not as bad as Apple. The absolute worst one, though, and I saved this for last, is Facebook, Meta. Okay, this chart is a dog. This is the worst, one of the worst charts I've ever seen. I mean, this is like, if I had to draw a chart that had crash written all over it, this is the chart. This is a chart only a mother could love. Dear God. I mean, Facebook is not one of the top five. I guess they call themselves Meta. I'm going to call them Facebook. But they are a huge company. They're one of the top 10. I think they're 7. And this is just the ugliest chart I've ever seen. You got this top way back here in September. You're selling off compared to the general market. You rally, that's rejected. You make a lower low, and then you come up and you hit this 50-day moving average, 200 moving day average convergence with this bar, with a gravestone doji with a huge upper tail. That is horrible. I got to get me some Facebook puts. Holy cow. But anyway, okay, going back to the big picture, the takeaway is there's this argument that the 5 to 10 individual stocks are the things that have been driving the market. Most of these charts are looking really ugly and headlined by Apple and Facebook. I mean, those two charts are horrific. Those two charts are horrific. Okay. All right. So that's reason number 4. The individual components, the top stocks look bad, and some of them look horrible. Number 5, S&P crude ratio is still really overbought. I mean, really overbought. Okay. This is an hourly. Where's the daily? This is the daily. We are still significantly above the 200-day moving average of this ratio, and the 50 is way below the 200. Okay. So you could say, and I do say, oil is still oversold. Fine. But if we're talking about the S&P, if anything, this is a negative force on the S&P. I mean, if we're going to have crude at 71, that implies an S&P level of 4,400. I'm not going to call it fair value, but if we're going to go retrace to the 200-day moving average of this ratio that I got up on the screen, that's what that implies. 4,400 divided by 71 equals the yellow line there. I think it's, what is it? 62. Okay, if we retrace to 58.5, then the S&P's got to go all the way down to something like 4,150, 4,100. Okay, a long way down from here. So for me, part of it, I'm bullish oil, so that's part of it. But if anything, it's a negative for S&P. So I'm listing it as number 5. Number 6, CPI is going to print between 6.5% and 7% tomorrow. That everybody knows that's coming. Okay, so maybe it's a non-event, maybe it's a sell the news event, but when it actually hits, I believe it will focus the mind of many people. Why? Because everybody knows that the Fed is meeting next week. And like I was saying, the market does not like uncertainty. That was point number 2. And when that number hits, it's just going to create this spidey sense, this gut feeling for a lot of investors that, maybe now would be a good time to get some hedges back on the book, or to hold off on buying, or, I got skunked on my puts last week or Monday or whatever. Time to reload. So I believe that print will add incremental selling to the S&P. It will take away from incremental buying, and I believe people will seek protection. And the 7th one I already mentioned, tomorrow is the end of the corporate buyback window. Folks, the stock market is a discounting mechanism. It looks into the future. The future, if the Fed tightens faster, is less good, okay? The future includes the rest of the year where we're not going to have any corporate buybacks. So tomorrow's going to be an ugly day. That's my prediction in the S&P. And right now is a good time to get in on the action. The VIX is cheap. What are we at? $21.5. Yeah, at 21.5. And there's a little bit in backwardation today between cash and the December futures. So this is it, guys. This is the time. Never seems like the time. This is the time. Now, I got to say, just, do your own research. This is not investment advice. Might have sounded like investment advice just there. I'm saying I think it's the time for me. You got to make your own decision. But, yeah, this stock market, to me, is looking really effing ugly. Next topic, crude oil. I already said I'm bullish crude. I think that the real economy should keep on chugging even if the stock market has some hiccups. So even though I'm bearish stock market, look, folks, I'm not bearish the stock market like I think the world is going to end, like we're facing a recession. That's not why I'm bearish the stock market. I think the economy is going to do fine. I think Omicron is actually going to be a Christmas miracle for us. If I was more advanced at this YouTube stuff, I would put the link in the chat as it is. All I'm going to do is I'm going to go to this guy's site and show it to you. Dr. John, I'm sure you've heard of him by now. He cites...
welcome to today's talk. It's Thursday, the 9th of December.
Is it even legal to do this? I'm sure it is. Omicron symptom changes.
Well, welcome, Wednesday, the 8th of December. We want to look at Omicron in South Africa, because where South Africa is now, the rest of us will be following on in the next 4, 5, 6 weeks as Omicron
he's talking about Omicron
variant throughout the world. So we're looking at things like clinical features, prevalence, resistance to vaccines in South Africa. Because this is exactly what we're going to experience ourselves in the next few weeks.
Omicron
so
has
let's
an
start
insertion.
Off with the clinical
let me
picture.
mute him.
This is from Dr.
Okay. Google this guy if you don't know him, Dr. John Campbell. Omicron has insertion mutation INS214 EPE. So COVID-19 caught a cold. COVID-19 merged with a common cold coronavirus, acquired this mutation INS214 EPE, and now it's super transmissible, 4 times more transmissible than the previous Delta variant, but it gives symptoms of a common cold. So I'm going to put it this way. What if this thing was 4 times more transmissible than Delta variant, but just gave everyone something akin to the common cold? I mean, just imagine that for a second. What would that imply? What would that mean? I mean, I think at some point, everybody is going to realize that they look damn silly closing their border against the common cold, right? And I think also from just a physiology point of view, everyone's going to catch this, or nearly everyone, and it's going to give everybody an immunity boost against all strains of COVID. So I really think this is the final chapter of this virus. And the final chapter is going to be that everybody catches a cold and then we're done with it. And at hospitals, I mean, they're still going to have people with COVID in the hospitals, but basically by February, by March, the serious hospitalization, ICU, and death rate will be, for COVID, will be close to zero. And the writing's going to be on the wall far before that. I'm calling it the Christmas miracle. The vaccine debate's going to dry up. And then I'm imagining there will be an increased demand for commodities, travel, services. I think there's still some pent-up demand. Even if there is a lot of demand, that's never going to come back because people will form new habits. Maybe they have new values. But I do think there is some marginal demand that will come back for things, and that will directly contribute to crude oil demand. So I'm talking traveling and commuting for the most part. So crude oil is a buy here. Crude oil is a buy. S&P crude is really overbought. I already stated that. Okay, last topic of the day, natural gas. Crude oil chart. Come on, baby. So we're up a little bit in the night session. But yeah, I mean, we've got a date with $77, folks. We have a date with $77. Are we going to be late to our date? Maybe. We'll see. Last topic is, well, you know, while I've got this silver chart pulled up, we'll just handle this. We're going to handle this. Silver looks, as I've been saying, it's been selling off, but it's getting very close to its buy zone. So let's keep a close eye on this. The Fed might provide the impetus to get us down to 1946. Guys, if you can buy silver at 1946, I can't give investment advice, but I'll be buying silver at 1946. Okay, last topic is natural gas. I do these videos without a toothpick near me. Okay, so natural gas has not been able to make any meaningful rally, and that includes on today's bullish inventory number. So I'm no longer bullish, I am bearish natural gas. 200-day moving average is resistance. Can't rely on a bullish inventory number. Weather is still a risk, but this is a good risk to take. In the winter, natural gas can move more than you think it can. So this is in stark contrast to that crude oil chart I was just showing you, where, you know, I'm arguing that because the 50 is above the 200, that we're going to kind of have this magnetic attraction back up toward the 50. Not the case here. Not the case here. Why? It's December. If the weather stays bearish, this thing can keep going down. Okay, this will not stop going down until the weather turns. And after today's bullish inventory number and the market selling that number, I'm switching to bearish. So yeah, well, there's a risk, but this is a good risk to take. There's always risk in the markets. Remember that. There's always, if you feel like you're not taking a risk, you shouldn't make the trade, because you're not gonna be happy with the result. That's what I got for you today, folks. I hope you enjoyed this broadcast. I certainly enjoyed making it, and I will talk to you tomorrow. Best of luck.